Hello and welcome to the third in our series of insurance pricing webinars, where I'll be discussing pricing outside of optimization. So I'll tell you a little bit about me. For those of you who don't know me, my name's Stephen Kennedy, and I head up insurance pricing at Pearson Ham Consulting. Prior to that, I was head of pricing for Hastings Direct, when I held that position from 2009 to 2017, developing that pricing function there over that period. A little bit more about us. So here are some of my colleagues. So that's myself on the top right, and Tim to the left of me, who's our founder and CEO. We've got Hazel and Rory. So Hazel is our actuary and engagement manager, and Rory is a pricing analyst. And hopefully you'll be seeing those people at some point later on in the series. So Rory will be joining us at the next webinar, where he'll be sharing some of his insights on behavioral science and how those can be used to help improve retention rates. A little bit more about Pearson Ham. And some of the areas that we operate in within insurance pricing. So we do price optimization. We can do that from start to finish. We have analytics and data that we get involved in. So we're very strong in those areas. So we have the technical capabilities to be able to provide that type of support. In addition, we also work on pricing strategy, making sure that the right processes and governance is in place to support longer-term business objectives, and trading agility, which is an area which is critical, really, if you're operating on price comparison sites, to be able to trade in a retail manner which is more flexible and agile than a traditional insurance approach. So we like to combine strong technical capabilities with commercial acumen and trading experience to be able to come up with the right solution to help grow business in a sustainable and profitable way. If you'd like to know a little bit more about that, we have an insurance pricing EBrochure, which you are able to download and peruse at your leisure. So that should contain a lot of background information about the types of things that we do, the work we get involved in, and where we may be able to help support in your business going forward. So as I say, today we're going to be discussing pricing outside of price optimization. So we work with a number of insurers who focus and invest a lot of time and effort into making sure that predictive models are accurate, doing all they can to improve the accuracy of those, ensuring that the batches that are being run through for optimization processes are representative of quotes that are expected in the market or upcoming renewals, to try and get that optimization process as accurate as possible. We have also worked with some insurers who do less of that. So on the kind of agile side, there are organizations who do more manual pricing and need to develop in the optimization area. So today we're going to be looking at, for those that do optimization, what are the other things that can be done? So we do know from experience that some insurance companies try their best to get optimization right and do all they can and invest in that, and they have pretty good processes in place. They're updating models with the appropriate levels of frequency. The models are pretty accurate, but they're unsure as to what else can be done as a pricing function to support the business outside of that. So last time in our webinar, we looked at different pricing elements that can be covered in a pricing review, and hopefully some of those gave you a bit of an indication as to some of the areas that you can look at improving and enhancing outside of just the nuts and bolts of price optimization. Factors like excess and other pricing levers can be used to adjust and amend the price that is being presented to the customer. Add-ons, pricing of add-ons is an area where there is still some work that can be done, and product variants and additional product benefits and how those are priced relative to standard propositions. Real-time behavior, so quoting in real time and adjusting prices based on things like quote manipulation and other behavioral aspects. Discounting, so there are aspects of discounting where pricing should be able to get involved to ensure that discount levels are appropriate and being targeted at the right customers. And there's trading agility, so are the processes there to enable you to be able to react and respond to the market when you need to. Also retention approaches, so renewal pricing, combined with some of the other retention processes to really help ensure that you're making the most of your base of customers and you're retaining as many of those profitable customers as you can. So I'd just like to run a poll next. And the question here will be, getting price optimization is right and is everything. To what extent do you agree with this comment? So getting price optimization right is everything. To what extent do you agree with this statement? So you should be able to see that poll on your screens now. I'll give that a few moments for responses to come in. Okay, so interesting range of responses that we're getting there. So there are some strongly agrees and agrees. 40%, just over 40% disagree with that statement. So hopefully some of the stuff that we'll be looking at today won't be a massive surprise to you. But for those others, for the majority who agree or strongly agree, then hopefully some of the information that we're covering today is going to be beneficial for you. So moving on to the first of the out of optimization pricing tools that we discussed. So excess is a pretty obvious and traditional one. So this is prices being adjusted by increasing or reducing the level of excess that a customer has to cover in the event of a claim. So sharing the risk with the customer can help bring prices down and to put you into a more competitive position. This becomes more important for those insurance providers who are operating on price comparison sites, where the differences between competitive prices can be extremely small. So any advantage you can get on pricing will help to move you up that screen. And we know that the correlation between rank position and conversion is extremely strong as well. So there are massive benefits to be had from being able to achieve positions 1 or 2 as opposed to positions 3 or 4, where you're much less likely to be able to convert those quotes to sales. And you can do this in a targeted way. It's not just around increasing excess levels across the board to get your prices lower, but you can do that in a much more targeted way to look at where you need to do it, how far away from the market do you think you are, and where it's going to have a less negative impact on conversion. So really being clever about where those excess levels are being applied, where prices can be reduced and positions increased, and really where you're going to get the biggest return on that activity. Levers. So this is about, there are a number of different elements that make up the price that is presented to a customer. And each of these represents a lever that can be pulled in terms of pricing. So there's your core premium and commission if you are a broker, which is essentially what can be seen as the price that the customer is paying. But outside of that, there are additional elements which make up the overall price that the customer will end up paying ultimately. So there may be fees associated with it. There could be arrangement and setup fees that are being applied. Some of these fees, if they're relatively high, may be off-putting to some customers, and also insurers and brokers may become over-reliant on fee income. We have seen FCA investigations into how pricing is done, which is focused mainly on pricing of the core policy to date, but fees may become an area of future investigation. And I think there's a risk for those insurance companies who have an over-reliance on fee income. So there may be customer benefits in reducing those fees or removing some of those fees, and looking at where those revenue streams can be generated in other ways. If the FCA come in and suddenly say we have to take out a lot of fees and you're over-reliant on that fee income, then you're in a bit of a sticky situation. So it's better to be able to spread some of that. So fees is an area which can be adjusted, and it's a lever that can be pulled to change the overall price. Also, installment payments. So there may be a deposit that's required for somebody who wants to pay monthly, and there is almost certainly some interest that's going to be charged on top of that. And there are different sensitivities that customers have to different elements of pricing, so to these different levers. So the interest rate is one which may be off-putting to customers. The APR figure on its own, regardless of what the overall amount being paid is likely to be, maybe another area that you have to look at maintaining within certain thresholds to avoid it looking too severe for customers. And the deposit is another element, so how much is being paid up front. And each of these elements can be flexed and can be targeted, and there may be some customers where they are less sensitive to a higher upfront payment because the interest that they're paying is then reduced over time, and those who want to pay as little as possible upfront and don't mind about that interest charge that's being applied. In addition, there are ancillary products and add-ons which a customer may also want to purchase. So each of these things is going to make up the overall price that the customer ends up paying and represents an area of potential pricing activity for your pricing team or lever that they can pull. So different customers, as I've said, may be more or less sensitive to different elements within that price. So it may be more or less appropriate to pull certain levers for certain segments at certain times. Moving on from that, add-on products is an area that I've mentioned, and some very sophisticated tools are being used and some sophisticated approaches are in place to come up with the optimized core premium pricing. But how much work is being done to assess the pricing of add-on products and how appropriate those are, and what kind of work is going into reviewing those prices, amending and updating those prices. Following the Insurance Distribution Directive, we're seeing more and more comparison sites now asking customers at point of quote which add-on products they're likely to purchase, and presenting back the most appropriate propositions for them. So it may be a case of making sure that you have the right propositions available at the right price levels. We are also seeing in the market more of that information being passed back to insurers at point of quote. So as well as the risk details being passed, the ancillary propensities or the ancillary preferences are also being returned, which allow insurers to then dynamically price either the core policy and or the ancillary products themselves, depending on customer preferences. And again, this opens us up to looking at differential pricing for ancillaries and opportunities to do that, and even price optimization of ancillaries, as well as optimization of core premium pricing. So there is obviously an interdependency there, which needs to be understood. And there are different segments which will react and respond differently to each of those elements. So going back to the levers and the sensitivities, the differences and the trade-offs between the policy and the ancillary product need to be understood more fully in order to come up with an effective pricing strategy to address both. One potential area to try and start addressing some of this is through the development and pricing of different product variants. So product propositions can be developed to meet customer needs more effectively, where customers are selecting particular add-ons at point of quote, then having a proposition which includes those particular items puts you in a position to be able to return an appropriate product offering, establishing the need of that individual and being priced competitively in the marketplace. So reducing cover levels can allow you to reduce premiums and achieve higher rank positions on the comparison sites. And conversely, additional product benefits, whether those are add-ons or other elements, can help improve the proposition. And there are some customers who are very keen to make sure that they have the maximum level of cover and are exposed to the lowest risk when purchasing insurance policies. Again, when comparison sites are showing the most appropriate products, to be able to have those products available as a proposition with all of the elements that a customer needs included, and to be able to price those appropriately is really key. And you need to be able to decide, how do you price these tiers, what the variance should be, and that takes you into a realm of activity which will go into how much value customers place on each of these elements and the combination of these elements. So what is the value of a combination of these elements as opposed to each one individually, and how much will a customer be willing to pay for that as a bundled product. There are also additional benefits that you may be able to realize through this. The types of customers who are purchasing ancillary products or are purchasing the higher tiered products may also represent additional benefits in terms of improved retention rates later on down the line. So if you are employing lifetime value models, then there are longer term benefits of making sure that you're getting those types of customers on your book. Another element of pricing outside of the core optimization will be real-time rules. And these are rules that we're seeing employed more and more, and for different reasons. So as technology has improved in this area, particularly around data enrichment, we're seeing the ability to interrogate several databases at point of quote before a price is returned. And these can be used to identify existing customers. So if somebody's in a renewal cycle and they're running a quote, you may be able to identify that person and make sure that the price that they're receiving is the same as what's been quoted in the renewal invite, so that you're maintaining that price parity, or you may want to take other action. I think the benefit is being able to identify those individuals and having a strategy in place to address and take appropriate action based on those. Another area is quote manipulation. So if a customer is running a quote and they've got 5 years, no claims discount, and they run another quote, and all of a sudden they've now achieved 9 years, then that's something which will flag potential fraudulent activity. And being able to identify that and take appropriate pricing action will enable better risk selection to take place. We are seeing more and more of seen before rules as well. So based on quote behavior, we can identify where a customer's previously run a quote, and maybe if they come back a week or 2 weeks later and run a subsequent quote, you want to make sure that the prices are remaining stable. So it may be the case that you want to maintain the price that was originally quoted, so there aren't any shocks for that individual, or you may want to take some other type of pricing action. But being able to identify that they previously had a quote from you will enable you to take a appropriate pricing action, whatever that may be, based on your own particular strategy that's being employed. We're also seeing more and more time-based rules in terms of time of day pricing, so increased risk of people running quotes in the middle of the night, as opposed to those who be running quotes in more normal working hours or daytime hours. And we're also seeing some demand-based rules where pricing is adjusting and being adjusted depending on the day of week that it might be. So some of these things are becoming more prevalent in the market, and there are areas which we are kind of getting involved in helping how best to target some of that pricing and what approaches should be taken. Discounting is another area that there is a big potential for pricing to add value in. So a lot of effort goes into making sure that price optimization is accurate, that it's as robust as possible, that all the models are being updated as frequently as they should be, the optimizations are being rerun, the conversion models are being updated in response to market activity and movements, and all of that's fantastic. But there's so much value being eroded at point of sale when the customer calls into the call center and is given a discount. So all of that sophistication goes out the window, and the actual price being paid at the end of the day comes down to the decision that's being made by the call center agent. So it's often difficult to trace discounting activity and to know whether value is being given away or is value being achieved by it. So are discounts being given to the right customers? Are the discounts that are being given the right level? So these are areas where pricing analytics can come in handy, to be able to take that information, to look at historic views on where discounting has happened, and to be able to come up with a targeted view on who are the best customers to be discounting and how much should they be discounted by. And this then allows us to make sure that discounting is important, and it's something that is expected by a lot of customers, and it has become a normalized activity. But we just need to make sure that the amount of discount that's being applied is right. We're not giving away too much, and we're discounting the customers who really need it and the ones who we really want to save. I'd just be interested in running another poll right now based on that. In terms of discounting, in your organization, how much influence does pricing currently have on the levels of discounting and where these are being applied? I'll just give that a moment. So I should have said at the beginning, if you have any questions, then please feel free to send them through using the chat function, and I'll attempt to answer those at the end of the presentation. So that's very interesting results we're getting back. So it's good to see that there's quite a high percentage with strong influence, and certainly the majority have strong or some influence on the levels of discount being applied. Just 10% there having little influence. So I think that it's good to see that pricing and analytics are able to influence some of the discounting activity that's taking place out there. So the level of value being eroded isn't as great as it could be, or as it potentially previously has been in the past. Agility is another area of focus outside of price optimization. So for insurers and brokers who are operating on price comparison sites, in particular, it's crucial to be able to take a more agile trading approach than may be offered by traditional price optimization. It takes time to build up enough data to create robust and accurate models to underpin the optimization. And in such a fast-moving market, conversion models and elasticity assumptions can quickly become unreliable. Approaches are being developed which enable reactive price changes to be made between more sophisticated optimizations. And these serve, which obviously the optimizations serve a purpose in making sure that there is a robust base level, but some flexing outside of that may be necessary in response to market movements which may have invalidated some of the data that goes into your optimization models. It's a case of being able to trade effectively while the data catches up with reality of an ever-changing market. So this involves changes not only to the systems that you may be using or the approaches that you're taking, but also to governance and processes to enable some of that speed of change to take place. And retention is another area where obviously price optimization is happening. Renewal price optimization is a thing, and it's often more effective than new business price optimization because there's less of a kind of reliance on elasticity. Elasticity is lower and more stable, so the results that you can get from optimization are more accurate, arguably. But what engagement is there with the customer during the policy term, and what can be done to help improve retention? So particularly as we're looking at potential changes in regulations and the price parity and dual pricing and what that means, what can be done to combine renewal pricing and price optimization with retention processes to try and maximize the return on the effort that's being invested in those areas? Are there any ongoing communications with customers? What understanding of changes in circumstances are there at renewal? What we have seen is a high proportion of customers, given asked what the reasons were for switching insurers, very highly coming out with the payment type. So they wanted to change from an annual payment to monthly payments, and rather than ask their existing provider to make that change, had changed provider altogether with a new policy with a monthly payment plan associated with it. So things like making sure that the customer circumstances are the same, not just that the risk details are the same, but things like payment type are also being considered in terms of making it easier and easier for that customer to renew and stay with you as a provider. How much is understood about when invites are sent? So the day of the week that they're sent on, what day do they arrive, the number of days between the invite and renewal. Has any work been done on trying to understand that better and optimize when those invites are being sent out? And what work has been done on price presentation? So we know that behavioral science has a lot to do with human decision making. So the way that something is presented can have a major impact and influence on how somebody responds to that communication. We'll be covering this in more detail next time when we'll be going into a holistic approach to the renewal process. And that's when I'll be joined by my colleague Rory, who will be giving you some of his insights on behavioral science. So just to sum up, there are several activities that pricing can do to deliver a competitive advantage outside of price optimization, and we know that many organizations are doing these things and investing a lot of effort and time into doing these things. Excess levels can be adjusted and different pricing levers can be pulled. Add-on products can be better priced and different product variants introduced and priced effectively. Real-time rules can be implemented and where the infrastructure is in place and discounting can be better controlled. Trading agility can be improved to speed up decision-making and change deployment, and retention pricing and processes aligned. So as I say, several insurers and brokers are using these types of pricing approaches to drive clear competitive advantages, and they are all areas worthy of investigation by yourselves. Thanks. I'd just like to move on to the Q&A session now. So I shall go into the chat to see what we have available. So do seen before rules have any GDPR implications, e.g. need to explicitly say that insurer will use data from one quote to inform future quotes? It's not an area that I've seen as being explicitly called out for that reason. There are implications in terms of holding that individual's details, and there tends to be caches in place, which would be typically 30 days that somebody will be held in that cache. And I think that in terms of allowability for those details to be used for those purposes, the amount of time that is spent in the cache will help to do that. Are there any concerns from an FCA perspective from using differential pricing for new business versus renewal as a result of using optimization tools? I think yes, is the short answer to that. And there's been ongoing investigations for several years now, looking specifically at that. So the optimization tool is essentially looking at a trade-off between price elasticity and customer value. Elasticities are pretty high, and on comparison sites very high. At renewal, much lower. So there is a bit of a trade-off there. We know that insurers are investing into acquiring new business with lower premiums than would be expected if they were not expecting those people to renew in subsequent years, and that kind of investment is being recouped through renewal pricing. So there is a bit of a dilemma there in terms of if dual pricing was to be phased out, then the new business prices would have to increase significantly in order to balance out the reduction in renewal pricing. But that's one. It's been it's something that the FCA have been struggling with for some time, and I'll leave them to come up with their appropriate response on how they deal with that. Okay. Are there any compliance rules with differentially pricing ancillary products? So we're getting quite regulatory today with some of the questions. And I think that potentially there may be compliance issues with pricing the same product differentially for different customers if they are add-on products, so things like legal cover. What you can do is look at different levels of cover. So it's not the same product, but there may be different customer needs. So some customers may need a higher level of cover than others, and the pricing of that can be different to a similar product with a lower level of cover. So there are different product variants that can be introduced rather than just having a standard legal and a standard personal accident and those types of things. So I think there are ways of doing it which will be compliant and will address customer needs. So they will make sure that you identify what is the right level of cover for particular individuals before presenting those products. Okay, I'm going to have to end it there, and I shall respond. There are a few other questions which have come in, which I can respond to outside of this with those individuals. So I'll send you an email later on after this webinar. So looking forward to the next 2 weeks. So our next webinar is on renewal pricing, a holistic approach to the retention process. So we'll be looking at renewal pricing approaches there, and also some of the other elements that I've briefly touched on in terms of that process, communications, and how those are likely to elicit consumer responses. So my colleague Rory will be joining me for that one, and he'll be able to provide some really interesting insights on behavioral science and how some of that might be useful in terms of being able to retain your customers. Okay, thank you very much. And as always, if you'd like any further information or need to contact me at all, then please feel free. My email address is there. It's stephenkennedy@pearsonham.com. So please feel free to drop me a line with any comments or questions that you may have. Great. Thanks very much, and I look forward to seeing you next time. Bye.